Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from social medias. I'm joined today by Nick Lawson, CEO of Ocean Wall Ltd, and Ben Finegold, Director for Ocean Wall, two very known names from the advisory business world. Gents, very happy to see you both here. Welcome.
Thank you very much. Thanks for having us, Lucian.
Thanks for coming to you both. Ben was in my show and we see him more often in the media. So I will take this opportunity to learn more about you, Nick, and your background. Tell me a word or two.
I was 17 years at Deutsche Bank and I managed a business called Special Situations. And that was where I was first had my interest peaked on uranium. And I'll come back to that in a bit as well. But I then went on in 2015 and joined the buy side. I was at the $7 billion multi-strat hedge fund Arrowgrass, which was a sort of US and European-based fund. In 2019, I decided to set up Ocean Wall. And the reason I did was because I thought there was a sort of paucity of offering from the bigger banks, such as Deutsche Bank, that I'd worked at. And I think a lot of it was a function of the changes that had taken place post the GFC and also MiFID. And in the last 5.5 years, I've built up a business where I've hired the very best talent. I've hired people from Goldman's and Deutsche and brought up amazing young talent like Ben. And the idea is that we will act as the sort of the best in class advisor, the consigliere. And so what we've been able to do on the research side is take a thematic such as uranium and then distill into that. So we now have every part of the nuclear fuel cycle covered. And it's worked out to be a very, very strong model. And, I think we can talk about this, the drivers that have led to uranium sit in other industries as well. I think we're now at an amazing confluence of technology. I think the fact that rates have gone higher means you've knocked out the carry trade clowns. I think the democratization of finance, something that you've been behind, has also meant that more people, it's more accessible. And I think in my career, which is now over 30 years of finance, I've never felt more excited about the opportunities that exist in global markets. And I think a lot of it is a function of geopolitical risk and macro, but I think a lot of it now is the technology that's coming through. And obviously that's something we can touch on a little bit later when we talk about the hyperscalers and nuclear.
Definitely we will. But I want to start, first question to you goes, because since you are the author of the tweet, and I quote you, Ben and I now believe that Cigar Lake moment is here again. You wrote that after Russia has announced restrictions on exports of enriched uranium to the United States. How will this impact the market, and what are the geopolitical aspects and implications of such move? And could this actually be even bigger than the Cigar Lake moment?
So let me take you back to the Cigar Lake moment itself. So in July 2006, I was given a deal that came across my desk, which was had just been listed on London. It was a small transaction. It was a $250 million IPO of a company called Nufcore. They stored 10 million pounds of physical oxide in Carcassonne in the south of France. None of us had any idea what this was. This was the days when we were doing amazing M&A transactions pre-GFC, and so it sat on the book. And then in October, Cigar Lake was flooded. Now, remember at the time, Cigar Lake was not due to be online until the following year.
Yeah.
So it wasn't actually part of the production schedule, the inventory for 2006. And the price just started roaring. And I remember sitting in front of my screen in November of 2006 with the head of derivatives, and we're looking at this thing, and we just made a decision that we cannot go on risk in Nufcore anymore, because every time we went on risk, the price gapped up 5 to 10%. Now, in the end, it was bought by Constellation Energy, I think it was in 2008. But what it did for me was, what is it that can do nothing and then everything? What is it that has the convexity of being able to rally in an absolute straight line? Now, obviously, it was a function of, because it was a Delta One instrument on the uranium price, it was a function of the fact that the uranium prices went from $17, $18 a pound to $143 a pound 7 months later. How could something have that convexity? And we started doing some work on it, and we realized very, very quickly, a little bit like this glass of water here. If I said to you now, what price would you pay for your glass of water today? You'd go, 50p a pound. If you hadn't had water for a week, what price would you pay? Your entire wealth. You'd probably look to steal to buy it. And it's exactly the same price elasticity that sits with uranium. There is no substitutional effect. There's nothing else you can put into an MPP other than uranium in its enriched format. And now people talk about, the ability to, have a supply response. Here we are now in the last 4 or 5 years. The price of uranium has gone up 4 times and supply has gone down. It is a unique commodity from the perspective that it's almost impossible to have a supply response take place. Now, we are fortunate enough to be Brokers Division Uranium, a world-class company that Paladin are looking to acquire. They first discovered pounds in the Athabasca Basin in 2011. Their day of extraction is 2032. Nothing moves quickly. And so, we have a lot of people say, oh, but the Russian ban is posturing, Trump will come in, he'll change the rules. None of this can happen, and all of it's irrelevant because the chain is so fragile. It's so fragile from the point of oxide extraction to milling, to fluorination, to enrichment, to fabrication, that even in the best of times, or the most liberal trading scenario, it's a fragile 2-year chain. What's happened with the Russian war is it's changed everything. And so when I talk about a Cigar Lake moment, I'm trying to take people to a point when we had this convexity, this parabolic move in uranium, and what did that mean? And I think we're about to enter that now. Now, I'm not going to be nailed to a cross on the idea that this is going to happen in the next couple of days or weeks, but this is now what is about to happen. And the reason why is there is no substitutional effect for a nuclear reactor other than uranium. Now, if you turn off a coal power station, you can go from hot to warm to cold in 48 hours, and you can restart it on the same amount of time. You take the fuel away from a nuclear power plant, and it's out for over a year, and it costs about $1 a day. Again, everything takes time in nuclear. The movement of uranium through countries, you need to have a Class 7 transit license because you have this situation where you have to be able to have a proper WNA permit to move uranium. You can't just say if it's not going through Russia, it can go through Turkey. It just doesn't happen. And so we can talk about this in the next half an hour, 40 minutes. But my idea is this idea of this move, and this move's about to happen now. I talk about apex predators. The apex predators have always been and always will be in this kind of space, the hedge funds. Back in 2006-7, the global market cap of uranium was $150 billion. You had 600 odd stocks. A lot of them were quite small, But again, you had this huge move because the hedge funds got in front of the utilities and started buying pounds. We had a brilliant commodities trader called Greg Adams at Deutsche. We got a little bit greedy. We created a uranium contract on COMEX. The GFC blew it up. But all we are trying to do is look to ways to make money from this trade. And the hedge funds piled in front of the utilities. And that's why I feel the same thing's going to happen now. But now, the global market cap of uranium is 80 billion. And we've got a fraction of the companies because we've had the secular bear market of downblended Russian uranium, Fukushima, and this situation now where we don't have the same number of stocks. So we have a global market cap, 1/10 of the enterprise value of ExxonMobil. We put out a chart recently which showed a sort of like a infographic of the sort of like planets or balls shaping where hyperscaler size is. And there's a tiny dot, which is global uranium market cap against Meta and Google. And we have this situation now where, just to give you an example, the Microsoft data center that's being built is 5,000 megawatts, so 5 gigawatts. And that will take down the power of 5 New York boroughs.
Yeah.
Just think about that. One data center taking down the entire power of the 5 New York boroughs. Now, you can't fill that through the intermittency of solar and wind and any of those other things, mainly because even if they could produce that amount of power, you don't have the battery storage capability of that. So we're now in a completely different paradigm, a paradigm of geopolitical risk with Russia, a paradigm of completely and utterly different new entrants against an asset class that is not capacious enough, i.e. does not have enough capacity for the wall of money that's about to hit it. So
Yeah,
that's the
all
reason.
great points. I agree on all, definitely. But just quick return on the Russian ban. This is not just US problem. It's Japan, South Korea, Mexico, Taiwan, and others will also see their shipments of Russian uranium halted by this new ban. Uh, could the United States and the other countries solve this problem with, let's say, U.S. utilities purchasing non-Russian origin EUP from China in increasing volumes to make up for the loss of Russian material? Or do you believe that Chinese EUP is locked for their own needs?
I certainly think that the majority of Chinese EUP is locked for their own needs. I think that, the majors there, CGN, CNNC, have been quite sort of, they've always been very vocal about that. I think the important point with the Russian ban now is that there has been so much around supply demand, and there's been so much influence from, think about physical sequesters, yellow cake, Sprott, think about hedge funds and traders, as Nick mentioned, and then obviously think about utility involvement. But the reason that this is so significant is because it directly impacts utilities. And we talk about uranium prices at $80 a pound today. Sort of, they seem to have found a pretty firm base just below that. It was the same in 2022, around $40 a pound. And I feel that we're sort of at that next base higher now for that sort of, I guess, the next leg of this move. The reason that's important is because I think that utilities now will drive this sort of next leg higher, where we will see a sustainable price higher than $100 a pound. And this ban directly impacts them. We're starting to see some news flow come out of it. I think the initial news there is one of, people that we've spoken to over the last few days is somewhat confused as to the details of this ban. There's a few things that we can talk about. One thing that we're pretty sure about now is that, well, we're certain about is that this came from the Kremlin, that this wasn't a sort of Rosatom 10x decision. This is from Putin himself. And obviously he spoke about how, his intentions to do this in September. We now see Centra sort of 40% off its highs, given the sort of reliance that they have on Russian imports. This 10x export license has now been revoked. And as you say, people talk about it like it just impacts US EUP. It's just not the case. As you know, this has massive, and your listeners will know, this has massive implications for fabrication that's done in the US, and then gets exported to countries like Japan, Taiwan, South Korea, Mexico, and then ultimately the impact on overfeeding. There was some sell-side research I was reading yesterday that adds now 15 million pounds to US demand by 2035, a 10% annual increase in U3O8 in just the US alone. If you take EUP, for example, Russia accounted for 27% of EUP into the US last year. The impacts for this will be profound. And if you just look at the sort of comments from, I think it was Andrei Listovsky, who was quoted in the article that we referenced in our research over the weekend, and he was talking about these two goals, political and economic, which is really cutting the US or cutting US utilities specifically off at the knees and saying, if you want to contract, you're going to have to do it at much, much higher prices. And ultimately, I can't iterate this enough. We can talk about the speculators within the spot market, or we can talk about what is going to move this sector and prices much higher for much longer. And that's going to be utility demand and what utilities are willing to pay for uranium.
I mean, we wrote a report, can uranium go east? And not 1 pound of uranium has ever left China, ever. And let's not underestimate the muscular influence of Russia in this whole situation, in cahoots, as in a bifurcation of West versus East. So we mapped every state visit that had taken place pre and post COVID. Now, Xi Jinping's first visit after COVID was to see President Tokayev of Kazakhstan. He's subsequently done 3 visits since. Tokayev went to China on working and state visits 6 times since 2020. Putin, who obviously turned up after Macron's visit with Framatome and Orano last November, he turned up the following week. Putin has done 6 trips, in total 6 days, 4 trips to see President Tokayev of Kazakhstan. Tokayev has gone to Russia 9 times since the end of COVID. Now, we've been out to Kazakhstan a lot, and it's a fascinating country. And, just to give your listeners an insight, It's obviously has Russia to the north and China to the east, and the Stans to the south and the west to the east. And when you go there, you have Central Europe's largest mosque. You have the Silk Road. You have the Cyrillic alphabet. You have a huge amount of Russian influence because obviously, they never had their colored revolution in the 90s. And then you have a Prada and a Sheraton, and it's this huge sort of confluence of so many different cultures. But at the end of the day, what you have seen, and it comes back down to the working minds that are now in Russians' hands, and Borovskoy being the most recent one, you now have this movement of uranium away from Kazakhstan to the west to Kazakhstan to the east. And if you look at the trade data that's come out more recently, it was at 70% of Kazakh uranium exports are going to Russia and China. Now, I talk about muscular influence. This is not a new thing. They've been doing this for a very, very long time. And you can take Putin back to a brilliant book that Marian Katusa wrote called The Colder War, which looks at the way in which Putin has played a very, very long game. Now, obviously, the first nuclear entry was back in the 1950s, but Putin has been able to pick this ball up and be very, very patient through the megatons to megawatts program. He's been able to flood the market post Fukushima with very, very low cost U-235 from tails that's flooded the market. But he's allowed a transient surplus to exist that's made the West completely addicted to downblended Russian weapons grade uranium to the point that they don't have a centrifuge that can operate in any foreseeable timescale. And it's almost genius by him on this very long-term game to be able to play this. And the fact that, the supply gut kept prices depressed and meant that, the West became addicted, as they did on Nord Stream gas. He's weaponized commodities. And now we're paying the price for that, which is the Americans may come out with almost a unilateral ban saying we're banning Russian imports, but it's like turkeys voting for Christmas. And suddenly their bluff has been called by the Russians saying, well, actually, I tell you what, F you. And where does that leave? Where does that leave the small, unregulated power stations in the US? Where does it leave them? We're now in this fragile chain anyway that's been broken at so many points. Where does that leave them? And I feel that we're now very much down to a matter of time.
Yeah, and when you say not 1 pound left China, would you say in this game of chess, if I may call it that way, is the West making the wrong moves and China locking up supply with much greater success? What's your take?
Yeah, well, I think so. I mean, China's now got 56 operating reactors. They've approved 11 more. They obviously will not want to export. Why would they?
Yeah.
Why would they? It makes no sense. I think we're now in a situation where we have quite literally this arms race in terms of building nuclear capacity. And why would anyone sell the most valuable commodity? And you look at what's happening with sort of the restart of 3 Mile Island. I mean, Ben and the team have been mapping sites around the US, where i.e. they were given permission for 4 power plants, but only built 2. Because I think we're now going to be facing down that situation of this rapid build. I mean, we're getting bank financing coming through. We've got obviously the Trump administration completely supported deregulating nuclear, but all of it's irrelevant if you don't have the fuel. I mean, one of the interesting things is that, when you have started seeing the likes of Oklo and TerraPower modeling small modular reactors back in the middle of the last decade, 2015, 2016, they're assuming SWU prices around $6,000 a kilogram, and that gave them an IRR of somewhere around 14, 15%. That's now at $23,000 a kilogram. And you can talk about uranium as an input cost being quite small for a very large reactor, which it is. But for small modular reactors, it's a much greater share. And obviously you have that density issue as well. So suddenly those IRRs have gone from 14, 15 to 0. So they've now got to secure a way of being able to get the end product, the HALEU, into their reactors at a far lower cost than where it is on the screen at the moment.
Right. Yeah. Ben, let's cover both spot and long-term markets. So let's start with spot. Why is the price not moving much?
Yeah, it's a good question. I mean, I think in a flurry of news flow this year in particular, some good news can often get lost because of how often it's coming. So maybe just to run through a few of those is We've seen production cuts from Kazatomprom, Paladin, multiple US producers. We've got landlocked uranium in Niger. We've had a US ban, we've had a Russian ban. That's just on the sort of supply side. On the demand side, we're seeing real clarity in terms of future demand from big tech and them sort of placing their bets on nuclear. As Nick mentioned, 3 Mile Island being restarted, China approving new reactors. They're going to improve another 30 to 50 in the next 5 years or so. And then, only last week, seeing COP29, another 6 countries pledging to triple nuclear capacity by 2050, taking the total now to 31. We're seeing big banks coming off the sidelines, willing to finance these projects for the first time. And also, I think an incoming administration in Donald Trump that's going to be very, very supportive for nuclear. So to your question as to why prices are not higher against that backdrop, I think is a very, very good one. Ultimately, I think that, if we look more recently, there was obviously an overhang of pounds from a Kazakh fund, which I think is now quite sort of commoditized news, that saw uranium prices come off sort of $5 or $6. It sounds as though those pounds have now been cleared, which is very positive and hopefully will allow us to sort of move higher. To my point previously, we were in a similar position in 2022, around $40, where we sort of hovered above and beyond. But also, if you remember, when Russia invaded Ukraine, we actually saw a spike to about $64, pretty much almost, immediately after that news, but then prices retraced. Again, without wanting to play the game of mirrors where this happened. So this happened. It's not dissimilar to what I think happened at the end of last year, where we went sort of 60 to 106 quite quickly, and then have now come back and rebased at 80. Ultimately, I think that the spot price will improve, but I think that it's slightly losing its relevance. Even the last few days, we've seen the equities really decouple from the spot price. Spot price fell $2 the night before last, and we saw brand names in this sector rally 4 or 5% yesterday. So I think that's very, very positive. On the term price, I think we're now 27 consecutive months of the term price either staying the same or improving. We saw a large term contract signed between the Kazakhs and the Chinese last month. I think around sort of 30-40 million pounds based off UXC data. And that would have inevitably been signed at higher prices. As your listeners will be aware, those month-end term prices, they actually report the lowest price for the month. So we weren't going to see that reflected in October, but we're likely to see it reflected in the end of November next week, which I think, we should see term prices also start to improve materially from there.
Can I just chip in on that? I mean,
Sure.
it's back in the 2010s, the spot market was very, very active. You had traders actively nickel and diming for 25-cent spreads. You had a Tochu, Trist, American Energy, and some of the banks, power trading as well. Since the UXC announcement of the era of inventory overhang is over, you've seen much less mobile inventory and the liquidity has dried up. Now, when Yellowcake came to the market in 2018, they anchored themselves to the spot price. And spot have done the same. And so what you have is you have this lens with which you look at these companies' valuations through, and it's the wrong lens because it was, but now it's not. And then you look at the term market and you can suddenly see, as Ben says, we're now in contango. We're now looking at a futures forward market far higher than where the spot market is. And yet what we do have is when someone comes in to buy or sell, it's a disproportionately exacerbated move up or down. And that is not the barometer. And what that does is it gives this idea of, it's a bit of a Jedi mind trick. We look at it from a perspective of the fact that ignore what goes on, but we know loads of people don't. So what it does allow us to do is it allows you to trade Yellowcake. You go, it's a 20% discount to NAV, buy them up. It's flat, sell them, and ditto the same with spot. It's effectively become a trading tool around the spot price. And the reason why is now, and I said it at the start of the call, it's a great thing. The democratization of finance means now is that you've got lots of people who watch and listen to your show, and lots of people that follow Quakes and us on Twitter as well, and they're looking at that as the barometer, and it's the wrong one. But it's also a useful one as a result. It becomes a trading tool, and it should be seen through that lens rather than where the price is going to be in 6 to 12 months. And I've said consistently in the last 4 or 5 year bull market, be unlevered, be fully funded, and sort of turn your computers off. If you really want to make proper money, turn your computers off. Because invariably, no one ever made money from nickel and diming these kind of situations at the moment. But had you put your money into Yellowcake at £1.30 just before the COVID in March 2020, you'd obviously be up a lot. But it feels for a lot of people that Yellowcake has been the wrong custodian for their capital. So that would be if I had to pass one thing back. I think the spot price is, as I said, a bit of a Jedi mind trick.
Yeah, yeah. Guys, can you provide me with the current estimate on how much uranium Kazatomprom has committed to China cumulative altogether in light of this new third contract?
I think giving an exact number is tough. I mean, I know we saw the third multi-billion-dollar contract between them, and they highlight that as 50% of the book value of the company. Um, I know this is not a technical answer, but a lot. I think that, as Nick mentioned, 70% of revenues in the first half of the year were attributable to China. You know, the Kazatomprom CEO himself coming out and saying that they don't really need to ship anything to the West. They have all the customers that they need to the north and to the east of their mines. So I think that there's this, this clear trajectory whereby we do have an increasingly bifurcated market where Kazatomprom just don't need to take the transport risk, the higher insurance premiums, and just the general bureaucracy associated with shipping material to the West.
Yeah, yeah. I believe that today's prices with this new deal, it looks like 31 million, something like that, at today's prices. Okay, Kazatomprom obtained the right for uranium exploration. It has a new block at Budenovskoye deposit. Preliminary data shows inferred uranium resources around 100,000 tons. So it's not a small project. What do you think? How far is that asset from first production?
Yeah, I think that the issue with Kazakhstan has never been the volumes that they have in the subsurface. It's been, as you guys will be well aware, it's been asset constraints, labor shortages, inflation across the entire supply chain as well. I mean, I think that these new assets that they're looking at, they have to go out and try and find, to try and expand the asset base. You know, Budenovskoye has been well documented as sort of that very, very large, or the asset that could improve incrementally Kazakh uranium production. The main constraint there being obviously acid and the quantum of acid needed to get this into production. I think that, again, we're starting to see a bit of a trend here in that the mines that are not operating at full capacity versus subsoil use tend to not be the Kazakh, Russian JVs or Chinese JVs. You know, Budenovskoye is a bit of an anomaly on that front. It was obviously down 84% versus what it was meant to produce this year for reasons that everyone knows now. Capco, however, the Orano JV was 44% off subsoil use, Inkai more than 20% off subsoil use, the Cameco joint venture, Ortelic 36%. So, we're really starting to see the ongoing production issues out of Kazatomprom. And I think that this is more systemic than perhaps knee-jerk and temporary that I think the market initially thought it was. So, for Budenovskoye in terms of timelines, it's really contingent on them getting acid. And, a few comments on that. As you guys know, there was two sulfuric acid plants built by the Italian company Balestra, which are in-house in Kazatomprom. Those took 6 years from sort of signing the agreement to full ramp up. That agreement was signed in for the third acid plant in January of this year. So even if you apply a 50% discount to that, that's 3 years from now. They're talking about having the acid plant online and fully operational by 2027. I think that's probably bullish. I would maybe take 28.9. So that's the acid that they're going to need in order to ramp up Budenovskoye. If you actually look at that release, they talk about an 11-year exploration license potentially. So I don't think that this is material that comes online sort of in this cycle. When we talk about the supply-demand deficit here, the real crunch point is the next sort of 18, 24 months in our mind. Ultimately, utilities look to contract 5, 6, 7, 10 plus years out.
Yeah.
But I think that ultimately they don't sort of maybe view those pounds as permanent or as for sure pounds as they had perhaps previously seen them.
Got it. Ben, one other question. How do you expect the conversion bottleneck to be cleared? How and when?
How I'm not sure. When I think that you look at sort of a 5 to 7 year time lag in terms of being able to bring online new conversion capacity. We've seen it from the likes of Orano, Urenco in the US, and also in mainland Europe as well. But ultimately, this remains one of probably the tightest bottleneck in the fuel cycle. Conversion prices up to 400% since the start of the war. And ultimately, you know, the news that we started talking about on this call in terms of Russian sanctions on EUP, I can't see a scenario in which that doesn't impact conversion sort of flows between Russia and the US as well.
Okay. Ben, this is actually my final question. How are you playing the uranium story with the exposure to equities? I know that you are a big believer in ASPI technologies. Is this your long-term hold, or do you continue to support them and buying at these price levels?
Sure. So maybe just the first comment on equities and then specifically on ASPI. We've always been of the belief that we don't want, you know, I think that the uranium sector is going to do a rising tide lifts all boats. But I think that we've decided to partner with one producer, one developer, one explorer, and then some picks and shovels plays. So the producer is Uranium Energy Corp, is the largest, most diversified portfolio of US North American assets. Specifically, there has to be a premium given the fact that the US only produces 0.3% of their domestic requirements. We think that North American names you know, warrant a premium. So UEC on the production side, Fission, of course, having an interesting time at the moment with the potential acquisition from Paladin as well on the development side. World-class management, world-class asset, and as Nick mentioned, you know, a large lag in production, but hopefully we'll get there before sort of 2030, depending on obviously permits, etc. Exploration being Sky Harbor, wanting to have exposure to a discovery in the highest grade uranium jurisdiction in the Athabasca Basin, but 29 shots on goal as opposed to taking single asset risk. We really like that. More recently, Lightbridge Corporation as a potential solution to improving the efficiency of traditional nuclear reactors using their patented technology for new nuclear fuel casings to be able to improve the efficiency of nuclear reactors by 30% a year, resulting in, on a gigawatt, you know, per gigawatt, about $60 million of increased annual revenues. And then ASPI, finally, you know, as a company we've been talking about for some time now. They have these three target verticals across medical isotopes, semiconductors, and obviously nuclear fuel. So nuclear fuel was our initial interest, but having now done a couple of trips out to South Africa, we understand that the opportunity there is not just unique to nuclear fuel. You know, your listeners love a supply-demand deficit. Nowhere is that more relevant than in nuclear medicine, with Rosatom being one of the primary global suppliers of these isotopes. In semiconductors as well, we saw news this week about this huge heating problem that most of these chips have because they use silicon-29, which actually has a negative spin around the isotope, around the nucleus, causing a major, really poor heat transfer, essentially. So silicon-28 is the market opportunity they're focused on there. And then HALEU, being the nuclear fuel sort of ambition here. Recent announcement from you know, an MOU with an agreement with TerraPower to build the first HALEU plant in South Africa. Just massive credibility for the business, sort of, you know, something that we saw ourselves 18 months ago, but having someone as credible as Bill Gates' TerraPower backing that up certainly helps, you know, their credibility in terms of the technology. So super exciting times ahead. Yes, the shares have had an amazing run, but think about it in terms of a $500 million market cap, but just on the HALEU side, 37 billion of pent-up demand from just two SMR customers, a total addressable market in medical of over $10 billion, and really just a very concentrated supply side landscape. Again, not dissimilar to uranium in that there are very, very few competitors and a real moat around this business. So, you know, ultimately, you know, we still find the company incredibly interesting at its current valuation, but it's definitely one to watch.
Yeah. Gents, I would like to thank you for this chat. It was a great one, and I really enjoyed it, and hope this is not that you will come back in my show in this format, both of you. Thank you very much.
Well, thank you for all you do. Thank you.
Thanks very much.